What is inflation? Cow want clover. Cow has no grass. Cow see clover price yesterday, 1 grass. Cow come back today, same clover, now 2 grass. Cow blink. Cow confused. Cow check again. Clover same size, same taste, same green leaf. So why cost double grass? Heifers, that called inflation. Inflation equals too much grass chasing not enough clover. More grass printed, same amount clover exist. Result, clover price go up, grass value go down. Grass weak, clover strong. Cow sad. Simple pasture example. Imagine pasture has 100 grass, 100 clovers. Each clover cost about 1 grass. Now farmers print more grass. Pasture now has 200 grass, still only 100 clovers. What happened? Clover price become 2 grass. Nothing changed except amount of grass. That inflation. Grass multiplied, clover did not. Why farmers print grass? Farmers say, economy slow, cows need help. So farmers create grass through milk bank system. Milk bank lower interest rates. Milk bank create liquidity. In human world called monetary policy. When central bank print money or lower rates, borrowing cheaper. More grass enters pasture. Sometimes good, sometimes disaster. Depends how much grass released. Year 1. Moo earned 50,000 grass per year. Clover burger cost 5 grass. Life good. Moo buy 10 burgers easily. Now 10 years pass. Inflation average 5% per year. Price formula, future price equals present price times 1 plus inflation rate times years. Burger price after 10 years, 5 times 1.05 to the power of 10. Approximately 8.14 grass. Burger almost 63% more expensive, but Moo's salary only grow little. Moo now buy fewer burgers. Moo angry chew. Inflation compounding problem. Inflation compound like investment, except opposite direction. If inflation equals 3% per year, money value after 30 years, value equals 1 divided by 1.03 to the power of 30. Purchasing power becomes about 41% lower. Grass still number same, but grass buy much less clover. Cow feel poorer even if grass stacks same size.
Types of inflation. Demand pull inflation. Too many cows want same clover. Demand high, supply low. Price go up. Example, all cows want avocado clover toast. Only few avocado trees exist. Price explode. Cost push inflation. Cost of making clover increase. Maybe fertilizer expensive. Maybe wheat transport expensive. Farmers raise prices to survive. Cows pay more. Monetary inflation. Farmers print too much grass. Currency supply explode. Classic example, Weimar Germany 1920s. Bread price doubled within days. People carry wheelbarrows of money. Grass everywhere, clover nowhere. Asset inflation. Prices of assets rise faster than goods. Stock market, houses, land. Example, house price 200,000 grass in 2000. Same house 500,000 grass today. Not always because house better. Sometimes grass weaker. Moo stand in pasture thinking. 4 stomachs. 0 hedge against inflation. Grass shrinking. Moo rhyme time. Grass lose power day by day. Clover laugh and run away. Real-world inflation numbers. Healthy economy often targets 2% inflation. Milk banks say this is sweet spot. Why? Small inflation encourage spending and investing. Too little inflation, economy stall. Too much inflation, chaos pasture. Example, U.S. inflation 2022 peak about 9.1%, highest in about 40 years. Food prices surge, energy surge. Cows everywhere complain.
What causes inflation spikes? Multiple forces. 1. Money printing. Stimulus packages, quantitative easing, more money supply. 2. Supply shocks. War, pandemic, drought, supply chains break, less goods available, prices rise. 3. Energy prices. Oil price increase affect transport and production. Everything become expensive. Energy inflation spread everywhere. 4. Wage growth. If wages rise fast, companies increase prices. Cycle begin, called wage price spiral. Inflation versus purchasing power. Example, Moo saved 10,000 grass under mattress. Inflation equals 4% annually. After 20 years, real value equals 10,000 divided by 1.04 to the 20th, approximately 4,563 grass purchasing power. Half value gone. Mattress not investment strategy, unless mattress stuffed with clover. How cows fight inflation. 1. Invest in clover, stocks. Stocks historically return about 7 to 10% annually long-term. If inflation 3%, real return still positive. Companies raise prices, earnings grow. 2. Real estate. Land and property often rise with inflation. Rent increases. Grass value protected. 3. Commodities. Gold, oil, wheat. Physical goods often rise when currency weak. 4. Inflation-protected bonds. Some government bonds adjust with inflation. Example concept, principal increases with inflation index. Less exciting, but stable. Hyperinflation. Hyperinflation equals prices increase more than 50% per month. Yes, per month. Example, Zimbabwe 2008. Inflation estimated 79.6 billion% per month. Money printed faster than cows chew grass. People abandon currency, use foreign money or barter. Pasture economy collapse. Deflation. Deflation equals prices fall over time. Sounds good. Actually dangerous. If cows expect prices drop tomorrow, cows stop buying today. Demand collapse. Businesses fail. Economy freeze. Japan struggled with deflation decades. Small inflation healthier than deflation.
Milk bank fight inflation. Milk bank raise interest rates. Borrowing expensive. Less loans. Less grass circulating. Demand cool down. Prices stabilize. Example, if interest rate rise from 2% to 5%, mortgages and loans cost more. Cows spend less. Inflation slow. Moo strategy. Moo earn grass. Moo invest regularly. Moo buy diversified clover basket. Moo hold long term. Moo avoid panic selling during fence-up market. Moo remember inflation always nibbling grass value. Investing not luxury, investing survival. Inflation equals grass losing power. Too much grass, not enough clover. Prices rise over time. Savings lose value if not invested. Smart cow move grass into productive clover. Time plus compounding beat inflation eventually. Moo stay calm. Moo stay invested. Moo ignore screaming financial peacock on TV and take care of your money. I'll be back soon.